Well, cries of peak inflation echo through markets. US dollar warning signs ring out. Equities march on. Crypto looks the goods. We go inside these factors and more as we assess the trade-off. Well, hi, my name is Chris Weston, Head of Research here at Pepperstone. And in 2 seconds, I'm going to be joined by Blake Morrow from Forex Analytics. And we're going to be navigating markets. We're going to be decising the various thematics that are going into these markets. As you can see here, with a few factors that we're going to be going through the show today, it's going to be an action-packed show. We're going to be talking about peak inflation, or at least the market's perception or hope of peak inflation. We're going to be talking about stocks and where we see them going. We're going to potentially, is there a meme revival? Some people have been talking about this. Blake and I argue whether that's the case. We look at sterling, we look at Aussie, we go through all these factors you can see here, and we assess the trade-off in that situation. Of course, if you find yourself wanting to comment on the program, do leave a comment in the comment section. Blake and I will get to those as quickly as we can. We love to hear your comments every day of the week. We love to hear some of your articulated views on some of the factors we're talking about, so do go to those. If you want to hit the like button, we'd appreciate that one as well. It really helps the program grow as we evolve as well. So I'm going to bring Blake into the program. Blake, how are you, me old mucker? Prices are coming down. Prices are coming down, are they? Coming down. We'll discuss those factors in a minute. Well, we're discussing.
Are they?
It's been a big night, mate. It's been a big night. Have you? Were you up? Obviously, you were busy trading the inflation report.
It was a very busy day, and a lot of key levels got tested. A lot got respected. A lot were broken today. So it's kind of a tricky market, and not to mention that we are in the middle of August, or in the beginning of August. So we're right smack dab in the middle of summer for so many people.
Are you not taking it? Is the Morrow family not taking a summer holiday? Are you going driving somewhere?
We've taken some sporadic little ones, but no big holiday this summer. It'll probably be this fall. So
very nice, mate. Get the skiing gear out and head up to the north, I suppose, is it?
Something like that,
mate. I was up at 10:30. I was the inflation numbers came out for me at night. That to me is almost midnight for me. So I'm an old man these days, so 8 o'clock bedtimes. But I'm looking a bit tired.
How did you trade it? How'd you trade it?
Well, let's find out, mate. Let's go straight to it, and we can actually talk about how I trade it, because I know that you've got some big views on markets as well. Let's go into Topical Thunder. Well, Blake, I want to talk about some of the ways that you've been trading, and we can go to some of those currency calls and various factors, because I know that you've been, you've been making some broker very happy, I'm sure. But the word of peak inflation's come out. Obviously, we saw the numbers coming out, the unchanged reading month-on-month headline. We saw core inflation up 30 basis points, which was about 20 basis points below the expectations of the markets on a year-on-year basis. Headline is growing at 8.5% at the moment. So, I think the worst fears of the market were alleviated, and you've got this idea that, this peak inflation narrative, which everyone's craving in the market, we're so desperate to see it, has come to fruition. Obviously, we saw airlines coming down. That was a very volatile airline prices, but they came down, and that helped lower that. We saw owner equivalent rents propping up prices there, and I think ultimately gasoline prices have helped lower that as well. Very volatile readings, but obviously the market is desperate for this peak inflation narrative to kick in. How are you reading the inflation story, and are we out of the woods at the moment?
Well, I think it's too early to say we're out of the woods, and really we saw it expressed through the U.S. Treasuries, and we saw it in the bond market today. The sell-off in yields and then the reversal back to basically break even. I think that tells us a lot, and I think it is too early to call at this point.
Mate, it's a great point. I mean, if you look at 2-year Treasuries, well, they dropped 20 basis points off the bat. That's a material move. But then they climbed back. I mean, they closed down 6 on the day. So it's a decent fall, but people were selling those treasuries at those lows, and they pushed up. We saw Neil Kashkari, we saw Charles Evans saying, this is a welcome relief, but it's not time now to do high fives and bumping chests and those factors as well. So whilst headline inflation has come back a little bit, at the end of the day, the Fed are still are not seeing this as like a done deal. We've still got an 8 handle on inflation, so they're still going to put the pedal to the metal, right?
Yeah, they are, and I think that you kind of framed it perfectly. just asking the question, are we out of the woods? The market is so deathly afraid that we are heading into a high inflationary environment like we saw back in the late 70s, that they're worried, so worried that we're going to be facing that again. And so this little bit of reprieve that we saw today, it was a welcome, it was welcome. You can actually see it expressed in the equity markets. So, because even though the bond markets reverse course, you would think the equity markets would have pulled back too, but they haven't, at least not at this moment, as we're actually speaking right now. So, with that being said, I'm still a little nervous, and seeing the reaction in the currency market, seeing the reaction in precious metals.
Yeah,
that's another had to double take.
Well,
right?
It's interesting if you have a look at the Fed funds future market, go to the what we call the terminal rate, which is the highest point, which is around sort of March. It was down 5 basis points on the day. The market's still sort of pricing 50 basis points, 75. There's a lot of market information to digest between now and September. We get another CPI print on the 13th of September. Market sort of 50s, it's 75. This hasn't changed the game. It's a weaker number, but it hasn't changed the game. There's still a lot of information that we need to digest over the near term.
Yeah, and and let's just go ahead and turn it over to the stock market, because I want to talk a little bit about equities, because I'm actually looking to fade this rally, Chris. And when I take a step back, and like
He's
I did
standing
today,
in front of a juggernaut right now, this man.
I know that's what everybody, and I haven't yet. So, well, actually, I take that back. I did in the NASDAQ today. I got out almost a break even and basically just stepped away, to let Asia and Australian markets do whatever they're going to do.
Yeah, right.
Kind of following up with today's CPI in North America. However, we've been bullish and very, very constructive on the stock market for the last couple of months here, Chris. Anybody who's been watching us here on the trade-off knows that, when we were trading at 3,800 in the S&P, I was all about getting long risks. So were you. And the markets have really responded. I thought it would be a stretch that we make it up to the 200-day moving average, which comes in around 4,300. However, I had to take a step back, look at how the other markets were responding. Even though stocks held their gains, we note that the bond market didn't. You saw in precious metals, they did not. You saw in currencies, we saw a move in the dollar, but it's suspect, and we're going to talk about that more, so make sure you all stick around for that. And let's not forget, the Fed is embarking on quantitative tightening. And in September, they're about going to double what they're doing now. So, as we are facing a tightening environment with monetary policy, does it really make sense to be chasing stocks up here? What do you say, Chris?
Mate, I'll tell you your quantitative tightening situation. The problem is that if you actually look at the liability side of the balance sheet, not the assets that are coming down, the actual excess reserves that are held, which commercial banks park on the Federal Reserve's balance sheet, have actually been increasing at a faster rate. So that's actually quantitative easing going in the market. So that's an interesting point. That will probably change in the near term. So your point is a valid one. Why does equities moving up? Well, you've actually seen excess liquidity going into markets and onto the liability side of the thing. So the market senses that as a kind of quantitative easing sort of situation. So I think that's a really important situation. Obviously, better data coming through or less bad data. We've seen that in services. So this idea of recession in the NBER's eyes have been pushed back a little bit. Still could happen, of course, but it's if you push back, some of the data's been a little bit better. And I think what we've seen the last couple of days is really a lot of the systematic funds, the CTAs, have their rules have been triggered where they've had to cover some of those short positions. And again, that's pushed us up. I'm not so sure that you get your fade, to be honest. I mean, I get what you're saying. But yeah, I wouldn't be short at the moment. I want to see a bit more evidence that the market's really prepared to roll over. So I wouldn't be fighting this at the moment myself. I think the technical break on the NASDAQ's really important. We've seen that January downtrend coming out, and I think there might be some more hedging flow that comes. Also, remember, Blake, that the VIX is now trading sub 20, so a lot of the vol targeting funds are coming back in as well. So I personally wouldn't be fading it. I get your point, but I just want to see a bit more evidence that the market's prepared to take this one down again. So we'll see.
Can we do another show on Monday between this one and the next one?
We should do. Shouldn't we? Mate, hold that point.
And then
mate,
I'm going to
hold
get
that
your
point.
take then. I'm going to get your take then.
Yeah, we'll see. No, but it's a long time between drinks, isn't it? I want to talk about that idea of liquidity, because a couple of days ago we saw Bed Bath and Beyond. I think at one stage it was up 66% on one, intraday, and then it came back a little. We saw GME and AMC and all these kind of, these meme names going absolutely bananas. I looked into the options world, and you obviously see the SPY and the Qs, all of those guys getting some massive options volume coming through ahead of options expiry at the end of the week. But what we also started seeing was that GME option, there was on Tuesday 77,000 call options trading hands for near-term expiry. And again, it just made me think, we've got that liquidity dynamic. Everyone's looking at the QE, as I talked about the liability side of the excess reserves going up. And then I thought, is this 2020? We saw crypto having a really strong move. We saw a lot of these meme names, not just on the equity side, but in the options world, the huge volume upside buying. And I thought, this isn't 2020. This is not 2020. Didn't want to put it out on Twitter because, of course, you're going to get slammed by people saying, "Oh, you're an idiot." But
right.
I was just looking at this, going, "What am I looking at here?" And we're seeing some of the hallmarks of what was going on there. Of course, we are seeing some risk taking in financial markets, and the dollar's now looking a bit precarious. But I just can't be going out and buying AMC and GME and all these names and Bed Bath and Beyond. Am I missing out on alpha here, or is this an area that we should be looking at? Maybe a little bit of a capital, or should we just stay well out of it?
I put my parents' net worth actually in Peloton just yesterday, so I don't know what you're talking about.
You put your in-laws' net worth on it, not your own.
No, I'm obviously just joking right now, so don't take that serious. But no, I look at that, and you made a point, like you saw some crypto names moving. Look, you want to look at the best risk barometer out there. It's not AMC and it's not Bed Bath and Beyond. Just go look at Bitcoin. Bitcoin is really the mother of all risk-taking proxies. Yeah, you have Ethereum moving higher, and we're going to talk about that a little bit later. I think there's reasons specifically that's actually moving. But I just look at Bitcoin, and it can't get out of its own way, Chris. And unless Bitcoin had literally been up, 10, 20%, the same time that those meme stocks were moving higher, I would maybe be talking a different tune right now. But yeah, I'm not falling for the AMC trap, and I'm not falling for the GameStop trap. Maybe Bed Bath and Beyond because I need to buy some stuff at my house. But no, jokes aside, I'm really not falling in that liquidity trap. So yeah. I'm with you. I don't. If I miss it, I miss it. Yeah. I'll let you take it.
Well, I'm not touching it, mate, to be honest. I'm not touching it, to be honest. And you go and get yourself some nice new towels and some bath salts. But, I'll stick to quality. I still think if you're going to be involved in this market, on the upside, on the equity front, you want to be in an Apple, you want to be in your Microsoft. These kind of names are working, and I would probably be in there. I'd probably be in the Qs as opposed to one of these names. I might miss out on some alpha, but I still think in this environment, of a precarious environment, I think quality over these kind of names. Yeah, you can have a little bit of fun, chuck $5,000 on it unleveraged and just see what happens. But for me as a trader, I'd still go in the quality end of town. For now, there's still too many question marks. Prepared to not take that risk on. We'll see what happens there.
I'm with you. I'm with you 100%. Let's as talking about risk taking. Let's go ahead and talk about the cable or the pound or the sterling. And my question is it time to start pounding the pound? Now, the pound is not, it's not the first time you've ever heard anybody say that, but I was talking to a gentleman named Dick Matthews the other day, and he's like, I'm going to pound the pound. I'm selling rallies. And
I'm sure there's a great pun under there.
I'm sure there is. I'm sure we could find one too. But, we got the Bank of England out of the way. They raised rates, but it was a dovish hike, as we talked about last week. They hiked rates. It was dovish. They talked about a recession. And look, you got UK GDP this week. You got CPI next week out of the UK.
Yeah.
But the question is, do you think the Bank of England, Bailey basically said they're going to be in a recession for the next 5 quarters. I don't know what central bank actually talks that way.
It's crazy, isn't it? How refreshing.
It was crazy, but refreshing.
Yeah. You don't really get, you're right.
If you're in the UK, it wasn't.
5 quarters of negative growth. And they're actually happy to admit they probably could have got away with less, to be honest. But the Fed are trying everything they can to say that there's not going to be a recession. Maybe they genuinely believe that, but then you get a central bank who comes out and says, we're going to get 5 quarters when the market wasn't even expecting that. And you're like, hang on a sec. These guys, they're acting like the central bank in New Zealand, who are always a little bit more honest than other people and actually, very forthright. But you're right. The Bank of England just brought their, and I think it was a shock to markets. They were, hang on, they're admitting this.
It was. So I've got to ask this question. Is now the time to sell it into this rally? I mean, technically, I don't have the charts for you right now, but we're following a big channel that we've been following basically for, I'll just say, since May of this year. So really throughout most of the summer and early or late spring.
Yeah.
But, the cable, this rally, I kind of want to sell into it. I haven't done it yet. But I'm asking you, what do you think? Is it time to?
No, I don't. I think cable's at the mercy of the dollar and risk, basically. If you're looking at it against the euro, that's another situation. That's what we look at, a pound or some of the crosses. The problem, the thing is with the pound is that you've got Rishi Sunak's fiscal support, which is still flowing through. That's the second half. The support that he had, the stay at home, the cost of living support is still about to fill through. So we're still getting a fiscal boost from that. The other aspect is that Liz Truss is probably going to win the Tory leadership. She's promised big fiscal stimulus, as has Rishi, but her fiscal stimulus will be more powerful and more potent. So you've got fiscal working, and it would work fairly quickly in that situation. So I think we get a 50 basis point hike at the next rate meeting from the central bank. Obviously, see what happens with CPI next week. And then I think we'll probably flip to more of a progressive sort of 25 basis point into the end of the year. So I think there's reasons to like the pound. There's a lot of reasons to not like the pound from a relative growth perspective. But I think the pound is probably against the dollar here, to answer your question, Blake. I think you were at the mercy, really, of the dollar and also just risk, really. If the S&P is going to keep going up, cable will probably test that top end of the channel that you talk about there. So it's an interesting one. We're looking at politics in the UK. I think Liz Truss has probably got it in the bag based on what we're seeing in the polls, but we can be surprised. Anyway, let's go to that's the setup and have a look at some of the charts that are on our mind at the moment. Well, Blake, first one I want to talk about is the Aussie dollar. I've conveniently titled this "Go on, you battler" or "Ya battler." Battler is a kind of a common term for the Aussie dollar. Yeah, it's the little battler, but is it a battler? Or is it just a proxy of risk? And I think for me, it's just the proxy of risk. It's not a reflection that the Australian economy is doing well. It's not a reflection of how our external partners or terms of trade and all those factors are. The fact of the matter is if the risk's going on and everyone's buying equities, then the Aussie dollar is going to go along with it, as is the case with the Nokia at the moment, as is the case with the Mexican peso, as is the case with the Kiwi dollar as well. So it's a proxy of risk, and maybe that changes. But what we can see on the technicals now is we've seen that we had a bit of a pullback into 68.77. The market found a platform. We sort of retested that downtrend. I know it's only touched 2 points, but then we've just smashed straight through it. We're into that top Bollinger Band at the moment, and we'd probably see that maybe ride higher. So I quite like this one at the moment. It could be considered an inverse head and shoulders pattern there, which takes us up into 72.68. I'm not a massive fan of head and shoulders patterns myself. I think they usually have a quite low probability of hitting those targets myself, but I know a lot of people will disagree with me. But the fact of the matter is here, Blake, that it's made a higher high. It's broken out. The question is can it push back into those former highs of 72.68? It feels like it can to me, but I guess a lot depends on the equity market reaction. What do you think?
Well, I think you have to buy dips. And, I'm very, very constructive on the Aussie. I love the Aussie dollar. I've loved it below 70 cents. And I feel a little naked right now that I'm not long as it was breaking out today because I'd been buying dips so aggressively for the last few weeks. I am going to be looking for a dip towards 70 cents to participate. But from a technical perspective, any dip over the next 24 hours or so down to 70-40, 70-20, I think those are levels that you might look at to see if we can get a bounce as long as risk appetite stays strong. And you put the nail on the head there. It's all about risk appetite. And I like the Aussie dollar as long as stocks continue to truck higher.
Yeah, I think that's right. I'll agree.
All right, so let's take it over to the gut B. Chris, it's the gut B. Now, I know we were, it's funny, pre-production of the show, we were talking about the pound yen, and I called it the guppy, but that's been its nickname for years and years and years.
Mate, I've been doing this since 1998, and yeah, I've never heard of the guppy, to be honest. So yeah, maybe I just need to I need to go back to Wikipedia and look at the names of currencies or something.
This is where we don't run in the same circles, and I guess if you're trading
you
sterling,
run in far better circles than I, mate. I'll tell you.
I don't know about that, but anyway, you know, when I was talking earlier about pounding the pound, I'm also slightly bullish the yen. And you saw the yen really move today. The dollar yen moved over 2% at one point. I mean, it was a big move lower. The yen really strengthened on the heels of today's data, or the CPI data. But I also look at the sterling, and it's struggling around a 618, which is basically below, 163.70. And as long as we stay below 164, I'm actually selling rallies, and I'm going to start looking for a move back down to the 200-day moving average. It's not like I'm looking for a home run here. I'm not looking for a move back down into the 140s. But I think realistically, you sell rallies, look for a move back towards 158, 159. What are your thoughts here on the sterling, yen, or the guppy going downstream?
Yeah, I mean, it's anything to do with the yen is basically a play on the bond market, right? So the Bank of Japan have got their ultra easy monetary policy stance relative to anyone else in the world, pretty much. Maybe the Chinese to an exception, but certainly the Bank of Japan are the ultra easy ones there. So if we do see a situation where long end bond yields or front end bond yields start moving lower, then any currency is going to converge with the yen. So that's really where you are. If you take a view that bond yields are going to go down, then you'd be buying the yen every day of the week. As a swing trade, yeah, I probably prefer it down than up. But you've got a fairly well-defined stop loss on the trade, haven't you, to be honest? So you know how much risk you're taking on the trade. You know your position size as a result. So as a swing trade, which is probably where you're going on this one, then yeah, I like it. But it needs a bit of work, doesn't it? I mean, it's just sort of hovering around there. I like to see things that are going down. So I'd like to see a bit more momentum in the move to compel me to want to take the trade. But yeah, I don't mind this. If you think bond yields have probably peaked, then you're probably bullish on the yen on that in that situation. The other way to express that is in crypto. So I want to bring up the chart of Ethereum. You talked about Bitcoin being your proxy of all those kind of junk risk-taking positions, and I know Ethereum has news which is idiosyncratic with itself. I won't go there because I haven't followed it closely enough. All I care about is the chart. That's a setup. We're looking at the setup. We're looking at the aggregation and flow of and thoughts in the market that are taking place at one time. And this is a chart that I've been bringing up, sort of every now and again, and I've used it in the play of the day, and it's not really given me much until now. And now we've had that chance where its head's really stuck above the precipice. And the question now is for me, is this about to start trending? We never know. Of course, we're not trying to anticipate as momentum potentially trend traders. All we care about is it's now had the breakout. We've had a close above the top Bollinger Band, the 3 days pulling away from the 8 day. We've got rate of change really accelerating here. I'll be long this now. I might get stopped out for a small loss, but it will be a small loss. I don't know where this is going, but hopefully this starts trend. This is the sort of setups that you buy with the anticipation that this starts going out for an outlier move. It's doing everything I want now, so I quite like this higher. What do you think?
Well, I think you brought this up as maybe a play of the day last week or something like that. And I'm going to say the same thing that I said last week, if it was last week. It might have been 2 weeks ago, but
2 weeks ago, yeah.
The high from April, and then if you take that most recent low that happened in June, the 38% retracement comes in at 1926. Now, it's a big deal to me because from a Fibonacci standpoint, if it holds that level, that means that downtrend is still really strong. But we're right there. And so if we can clear that 1926, get towards 1930, the next stop for Ethereum is 2250, 2243, which is the 50% retracement of that move. So when you talk about, I like to see if trends are going to evolve. I think if it makes above the 38% retracement, the 50% retracement is the next stop, and you get a breakout.
So what do I do? But we're just going to the next question. As a trend follower, as a momentum trader into a trend, if it closes above the Fibonacci, I'm looking to add, right? Is that the way you'd be doing it?
Yeah, that's exactly it. Yeah, that's exactly how I'd play it. It's like, if I'm compelled to buy it right now, fine, you buy it, you got your risk parameters, you know where you're going to get out. It gets above that fib level, closes above there, spend some sustained time above that level, then you add to it. That's the way I play it.
Beautiful.
Yeah, you add to your winners. So
correct. Yeah.
All right, let's take us over to the Dow Jones Industrial Average, and this is a setup. That's what this segment is, Chris. This is a setup specifically to the Dow, and the Dow is. I know we've got a breakout in the NASDAQ. You pointed that out. The S&P is trading above 4,200. That's kind of a breakout right now, but it's going to be interesting to see if the rest of the market's going to take off. By the way, the mid-cap market, the IWM, also is a breakout. So really the lagging index, or the lagging index is the Dow Jones Industrial Average, and we're right there. I mean, we are literally right at the breakout point. So what I'm going to be looking for over the next 24 hours or so is to see how the Dow reacts around this 33,450 level, that resistance. It's a descending trend line. You got the 200-day moving average right above it. But if the markets can sustain a breakout, then you got a breakout. But if it fails and you start to see the S&P dive, you see the NASDAQ give up some of these gains over the next 24 hours, then you sell this index because this is the weak hand.
Yeah, right.
This is the one that's not participating. That's why it's a setup. So I think you should be watching it.
Last week I brought up the NASDAQ as a setup. Yep. And we looked at the downtrend there. We looked at the idea of scalpers looking at levels around there to scalp off when, and that worked out really well. People were just looking at that and then just taking these quick moves off that. And then again, this is perfect. You've got that horizontal resistance. You've got the downtrend resistance. So the scalpers out there looking at levels just to take a quick one off there. I think that's going to be one that you have to have on the radar there. As a momentum trader, though, and a trend follower, then you want to be adding on a break of that because it's going to be significant. But I think, the NASDAQ's led this rally up and that's broken the trend. It's made a higher high. It looks good at the moment. So, yeah, we'll have to watch there. But I think certainly for the scalpers out there who look at levels to try and trade against, I think this is a really great chart. So it's a setup. I think that's where we're looking at. You can give people levels to look at is how markets obviously react off those levels. That's obviously the most important situation, right? So a good chart to see. So, thanks for bringing that up. Anyway, let's go to play of the day. Blake, I went for lumber last week. It was doing okay first couple of days, and we had a shocker overnight. It was up 9%, so we were out of that trade. This week, I want to look at ways to trade dollars against the dollar. So I'm really looking at the weakest technical situation. I love selling weak. I love buying strong, as you know. And right now, when it comes to dollar flows, I think this looks like the weakest play. Dollar MEX is going to be interesting. We've got a central bank meeting, I think it's either tonight, where they're going to raise 75 basis points. So I was looking at dollar MEX, but right now, obviously, we saw the Aussie dollar trade there, but dollar Swiss is looking weak. I think we probably get a bit of a retracement. I'd be looking to sell into that level for a move down into 93. But for me, as a way of expressing a dollar play, I agree with you. I wouldn't necessarily wanting to be long euro dollar at the moment. I think we're probably going to find there's no reason to be in euros, just a little bit of short covering playing through. But dollar Swiss looks nice to me. You get a bit of cyclicality coming through in there. But when it comes to weak currencies, I don't know. For me, this looks like the weakest hand, and that's what's just gravitated to me and said, Chris, come and have a look at this chart. From a daily perspective, I think this one goes lower. I think selling rallies makes a lot of sense for a move down into 93 there.
Well, I tell you what, the Swiss franc, you've been all over it, Chris, for the last several weeks, and it continues to play through, and it continues to pay you out. So Kudos on you. I'm going to take not the other side of that trade, but I'm going to take the euro dollar as my play of the day, and I am going to be talking my book. First and foremost, let me just go ahead and say that if you hear my analysis in other places other than the trade-off, you've heard me utter the number 103.50 about 1,000 times. That was the breakdown point from back in 2016. It's been a big pivot. If you look at this year, back in May and in June, those were lows that held. And guess what? We spiked right into that resistance today following the CPI numbers. And guess what? I was waiting to sell it, and I sold it right around the 103.50. I actually kind of leveled into it, and now I'm actually short. Now, I've been looking to sell this level, so this is, trade your plan your trade, but I'm also looking to actually add to this currency too. If we fail and we close back below 102.80, I'm actually going to get more long the dollar, and more short the euro, because I look at the euro crosses, the euro Aussies breaking down. I played it to the long side last week. It turned around and is heading lower. Euro sterling, euro kiwi, euro almost everything. So I love the euro to the short side as long as 104 is not breached.
Yeah, great stuff. Well, if anyone wants to get in touch with Blake and read some of his real-time analysis, do reach out to Blake on Twitter. So they're doing some good stuff there at Forex Analytics. So some good way to generate some alpha by getting in touch with the guys there. So definitely one to watch there. Anyway, that's all the time we've got time for at the trade-off. We've gone through a number of different facets of the financial markets. It's been another breathtaking week with twists and turns along the way. Obviously, the dollar's been very much in focus. We've looked at equity markets. We've looked at commodity markets. But that's all we've got time for. If you want to comment, leave a comment, hit the like button. We'd love that. Anyway, we'll see you next week for more of the trade-off.